Hello, I'm Ken Carpenter. Welcome to Invest AI Savvy, where AI powers smart investing. Welcome to Wednesday, May 13th, 2026. Yesterday morning, the number hit and it was hotter than the market wanted. April CPI came in at 0.6% month over month and 3.8% year over year. Core CPI came in at 0.4% month over month and 2.8% year over year. In plain English, inflation did not cool, it reaccelerated. And that matters because when inflation comes in hot, yields go up, rate cut fantasies get pushed out, and the most crowded growth trades suddenly look a lot less comfortable. That's exactly why yesterday's pre-CPI caution was the right call. So today's not a mystery story anymore. We know what happened. The question now is what survives after the print? Before we start, BuzzPulse is a social intelligence tool. Everything you hear today is data and commentary, not investment advice. I'm not your financial advisor, so please do your own research before investing money anywhere. Broadly, the answer is this. The market took the CPI number as a problem, not a relief. Bond yields climbed, tech got hit, the easy version of the bullish story got delayed again. That doesn't mean everything is broken, but it does mean the burden of proof just got a lot higher. And that's where BuzzPulse earns its keep, not by shouting a ticker at you every morning, but by telling you when the tape is clean and when the tape is lying. And right now, the tape is still messy. Normally, this is where I give you the one stock out of roughly 57,000 symbols that all the signals are pointing at. The one name where social attention, momentum, and market context line up cleanly enough to call it a true standout. Today, May 13th, I can't do that with a straight face. Not because nothing's moving. Plenty of things are moving. Plenty of stocks are up and down. But after a hot CPI print, a lot of that movement is just repositioning, macro stress, and traders reacting to rates instead of reacting to company-specific conviction. That's just noise. And BuzzPulse is supposed to filter noise, not dress it up. So instead of pretending there's a perfect setup when there isn't, let's talk about the two names from yesterday's script and what the new CPI reality does to them. First is SOXX, the semiconductor ETF. Before the inflation number, SOXX was the cleaner momentum expression. If you wanted exposure to strength in chips without trying to pick one single winner, SOXX was the logical choice. Now, after the CPI print, that logic got a lot weaker. Semiconductors are still one of the strongest long-term themes in the market. That hasn't changed. What changed is the short-term backdrop. Hot inflation means higher yields, and higher yields are poison for the part of the market that is priced for perfection. Yahoo Finance showed SOXX weakening after the CPI reaction, and early Wednesday trading had it down again from the prior close. So the message on SOXX is no longer buy the strength. The message is wait for stability. If semiconductors are really as strong as the bulls think, they don't need you to chase them on the first ugly macro reaction. They need to prove they can absorb it and hold up. SOXX stays on the watch list, but the tone changes. Yesterday, it was the cleanest momentum name. Today, it's a test of resilience. Second is DGXX. This is a completely different animal. DGXX is Digipower X, and the reason traders are talking about it differently than semiconductors is this is not just another chip-adjacent name getting pushed around by rates. Digipower X is an AI infrastructure and energy company that develops data centers and has been pitching its NeoCloud's GPU as a service platform on dedicated NVIDIA infrastructure. That gives the stock a more speculative, story-driven identity, not will inflation hurt valuations so much as will traders chase the next AI infrastructure name with a catalyst. And with Digipower X scheduled to report first quarter results on Friday, May 15th, the stock suddenly had what momentum traders love most, a clock. In a hot CPI market, that kind of near-term event can matter more than the macro backdrop because the trade becomes less about interest rates and more about whether speculative money still wants an AI-themed squeeze candidate with a story and a date attached to it. But don't confuse that with safety. This is not a fundamentals first setup. This is not a sleepy value stock. This is the kind of name that can rip on attention and reverse just as quickly when that attention leaves. If you look at DGXX, you're not making a calm macro call. You're trading crowd psychology with a catalyst on the calendar. So the update is simple. SOXX became weaker after the hot CPI print because semis sit right in the blast radius of a higher for longer rates. DGXX became relatively more interesting only because it's trading on a different engine. That doesn't make DGXX better, it just makes a difference. Now, what are you going to watch today? You watch yields, you watch whether tech keeps bleeding, you watch whether semiconductors can find buyers after the first CPI punch to the face, and you watch whether the small cap speculation crowd is still alive. Because if it is, names like DGXX can keep moving even while the macro picture gets uglier. But this is the key point. After a hot CPI inflation report, you do not need to be a hero. You do not need to force a trade because the market opened. You don't need to pretend every red candle is a buying opportunity. Sometimes the most valuable thing BuzzPulse can tell you is not buy this stock, but be more careful right now. That is what today's market is saying. Before the CPI report came out, traders were mostly operating on guesses about what the inflation number might be. After the report came out, guessing stopped and the market had something real to react to. That changes the job. The goal is no longer to predict what might happen. The goal is to understand what the new information means. In this case, the inflation report was strong enough to worry investors, which put pressure on riskier parts of the market, especially technology and semiconductor stocks. It also made weaker, hype-driven stock setups more dangerous because when investors get nervous, they become less forgiving. Some small, crowd-driven stocks may still jump for short periods because of speculation or social media excitement, but that's a very different kind of trade. It's faster, riskier, and less stable than buying a stronger stock in a healthier market. So if you want the clean takeaway, here it is. SOXX is now a wait and see name. DGXX is now a high volatility attention trade with an earnings clock on it. And the market as a whole just got a reminder that inflation is still the boss. Remember, BuzzPulse tells you what the market is talking about and whether that attention is unusual. It doesn't tell you to buy or sell anything. That's your call. I'm Ken Carpenter. This is Invest AI Savvy, and that's the way it is.